The IEA has cut its global oil demand growth estimate by 220,000 barrels a day for 2023. It's basically what OPEC was already responding to, a slower demand growth environment, a slower industrial demand growth environment all over the world, but particularly in developed economies and in China. And certainly what the IEA is showing is that although there is a downward revision of demand, it is still a robust growth environment for oil demand. Furthermore, what the IEA shows is that supply cuts are starting to make a dent on the supply-demand picture. However, the supply-demand picture remains ample. There is plenty of supply. There is no real concern about access to supply. Furthermore, what we can certainly see is that, if anything, the supply cuts from OPEC Plus have been fundamentally to address the global demand weakness, not to elevate the price at any cost. What we have seen in any case is that, as we said in this vlog a few times, is that global commodity prices that were slumping throughout the period of hike of rates and throughout the period of global slowdown, the reality is that those have reached a bottom, and that the price of oil reached a bottom more or less around May 2023, with a recovery that is slowly creeping up despite the fact that oil prices remain below the end of 2022 levels and significantly below the levels prior to the Ukraine invasion. So, oil prices certainly and global commodity prices have reached a bottom. What does that mean for global growth and for inflation? One, the positive impact on headline inflation that we have seen in the last 12 months is starting to unwind. In the latest US CPI print, the energy component was up 0.6% in June. Second is that the global GDP growth, and particularly developed economies' growth, has been aided by very weak commodity prices. Lower import prices boost GDP for developed economies. And that is also a tailwind that is over. So, global commodities and oil prices in particular seem to have reached a bottom, probably moving in a sort of not very bullish trend, but certainly a bounce trend, and that will certainly take some of the improvement in GDP and some of the improvement in inflation out of developed economies. So, not a positive environment for GDP as imports start to creep up, and not a positive environment for inflation as the energy component starts to creep up as well. That added to the fact that stimulus plans are starting to show that they have no multiplier effect, and that the level of surprise, economic surprise of the services sector is winding down, leads us to be very prudent about developed economies' GDP growth.